Creating passive income with infinite banking. Passive income is a rather hot topic. Everybody wants to make easy money with no work or as little as possible, and to add to what they already have going on. Now, I've been hearing from clients that they want to create passive income so they can work less, spend more time with their family, or beef up their retirement nest egg. So I want to share here what a number of my clients are doing that does exactly that, generates passive income. There's a chapter in my book, uh, Tax-Free Cash Growth Warehouse Nuts and Bolts, about this, but I know that a lot of people prefer to watch a video than to read. So here you go. First, let me introduce myself. In case you're new to this channel, I'm Stan Cox, principal broker and strategist with SC Finance Strategies and Insurance Consultants. I'm also the author of the books on the tax-free cash growth warehouse strategy, and I'm the managing director of the Hawaii Financial Freethinkers Academy, which is a nonprofit financial literacy education organization. For the past several years, I have focused on and specialized in the infinite banking concept and developing the tax-free cash growth warehouse finance strategy. So if you find this to be helpful, please like this video and subscribe to this channel. Also, please post your questions and comments here. Okay, now this passive income strategy is similar to just about any investing strategy using infinite banking. But this particular strategy gives you a double hedge against any possible loss, and I'll explain further in a minute. The strategy I'm about to lay out here for you is also very similar to what commercial banks do. I'm talking about lending money in the simplest terms. But in this case, we're working with a very specialized niche, the fix and flip niche. So yes, it involves real estate investing, but for you as the infinite banker, you'll be investing in real estate as a kind of a secondary kind of investment. Instead of you actually buying a piece of real estate, fixing it up, renovating, or even building a house and then selling the improved property, you'll be the one or one of the ones who loans money to the fix and flipper for their project. So rather than you investing in the real estate, you're basically investing in the fix and flipper who is investing in the real estate. But at the same time, you get the actual real estate as collateral for the loans you give to the fix and flippers. And that gives you double security for your money because you don't actually withdraw cash from your tax-free cash growth warehouse. You leverage it with a policy loan. So your money is still safely within your TFCGW account. Then, as a condition of you loaning the money to the fix and flipper, you secure the loan that you're giving them with the real estate that they are fixing up. You do that by drawing up the loan agreement so that as a condition of the loan, if your borrower should default on the loan, you get title of the property, which will undoubtedly be worth much more than the loan that you funded. So you have that double protection for your money that I mentioned a minute ago. Here's how this strategy works. First, you need to get connected with a group of people who fix and flip. Now, some people do fix and flip projects as a side hustle, and some do it as their full-time business. There are several Facebook groups and a number of groups on LinkedIn that are all about fixing and flipping. And I'm sure there are many others in whatever area you are in or you live in. So when you become a member of these groups, you'll want to make it known that you have money to lend for these projects. And if you can connect with an active builder who not only does fix and flips, but is also associated with others who do it, you will be able to get referrals and start turning your money over and over as what is called in that business a hard money lender. Now, let's run a simple example. Let's say you have $50,000 to leverage in your tax-free cash growth warehouse. And some fix and flippers will only need to borrow maybe $20,000 to do their project. Some will need more. But let's say you have a fix and flipper that needs $50,000. Normally, these loans are fairly short term. Typically, a project like this will take only 6 months or even less to complete. And then, of course, the property will need to be sold before profits are realized and the fix and flipper can repay the loan. So it's a good practice to learn as much as you can about the fix and flipper you will be lending to, as well as the specific project they'll be working on. And you'll want to know what their experience is with fix and flip projects, how many they've done before, how long they took to complete, and sell them, things like that. In other words, their reputation, reliability. Also, you'll want to know what they expect to resell the property for when they're done, and how strong the market is in the area that they'll be selling the property, and if their projected sale price is reasonable for the area. Again, the fix and flip groups could be real asset in these areas to learn things from. Okay, now you have a fix and flipper to work with. You're satisfied that they're competent and low risk as a borrower. You have your lawyer draw up the contract. And on that, I have found that prepaid legal services are very cost effective for drawing up contracts like these. I'm not going to go into details here because I'm not selling prepaid legal services, but check into it because it's a really economically practical. You'll need the contract to state the amount of the loan, how much interest you will charge for the loan, and for what period of time. For example, 12% simple for up to 12 months. Be clear that that means the borrower will pay you your money back plus the 12%, regardless as if it takes 12 or 6 months or even less. You get your 12% profit on your money regardless. But if it goes over the stipulated 12 months max, an additional 12% will be added, and the original 12% plus the additional 12% will be due even if the loan is repaid in just the 13th month. But they will then have up to an additional 12 months to repay the total. On the other hand, if you choose to be hard line about it, you could claim a default on the loan if it isn't repaid according to the original terms and foreclose on the property. I personally would tend to be lenient, especially if there are extenuating circumstances such as a downturn in the real estate at the moment or a personal setback for the borrower. And being a hardliner in those cases would likely shrink your potential pool of borrowers and make your passive income rather short-lived. But hey, it's up to you. So now let's look at how that whole scenario could work out. Your $50,000 is growing at, say, 6% in your tax-free cash growth warehouse. You're being charged 5% simple on your leveraged loan. You loan the hard money to a fix and flipper at 12% simple. You see where I'm going with this, right? Your fix and flipper repays you in 12 months $56,000. That's the loan principal of $50,000 plus $6,000, which is 12% interest. You also earn $3,000 on the same $50,000 in your tax-free cash growth warehouse. You then pay your 5% simple interest on your leverage loan, which is $2,500. Your net gain on this deal is $6,500. And you also get to deduct the $2,500 loan interest you paid on your leverage loan. So really, you made $9,000 and only have to pay tax on the $6,000. So what if, and this is likely, your borrower pays you back in just 7 months instead of 12? You still earn the 12% on the loan. You're still earning 6% in your tax-free cash growth warehouse on the same money. But now you only owe $1,750 in interest for the leverage loan. That's because it's prorated to just the 7 months that you kept the loan without repaying it. So now you're up another $750. And then you can repeat the whole process. And as your cash value of your tax-free cash growth warehouse continues to grow, you can loan larger amounts and or do multiple loans. Again, this is just an example of how this particular strategy can work. And you can charge whatever the market will bear for your loans. Could be 10%, could be 12%, might be 15 or even 20%. It really depends on the market and how generous you feel. In any case, it can be quite profitable and a very viable passive income business. Of course, as a number of my clients actually practice this very strategy, but with the addition of actually being the fix and flipper themselves, as well as the hard money lender for their own projects, you can see how profits would be considerably greater in that case. And not only that, but as the fix and flipper borrower and the hard money lender, when you charge your fix and flip business interest on the loans, you can actually deduct that interest that you charge from your income tax, as well as the interest that you pay for your leverage loans, which you then loan to your fix and flip business, because both interest charges are costs of doing business, even though you're paying the fix and flip interest to yourself. Okay, time's up for this program. Please like this video, subscribe to this channel, post your comments and questions here, and I encourage you to take advantage of this incredible finance strategy. I'm here to help. Feel free to book a phone call or video meeting with me on my Calendly page that's listed in the description box below. For a more complete explanation of the tax-free cash growth warehouse strategy, you can watch our free 60-minute webinar. The link is in the description box below. The link to buy my books on Amazon.com is also below. And if you'd like to apply to become a client of ours, the link to the application is also below. We're here to help, and we look forward to helping you. Aloha and mahalo for watching.